to another Wall Street Journal Spreecast. I'm Sudeep Reddy here with John Hilsenrath. It's a big day in Fedland again. We've got a FOMC meeting with the decision coming out at 2 o'clock Eastern, and then Janet Yellen's first press conference following half an hour later. John, it is a big moment. We're all going to be watching Janet Yellen. We're going to talk about all of that. But first, I want to get your take. What do we know the Fed will do today, and what are we waiting to hear from the Fed about today?
Right. So here's a few things we know. We know, I would say, with 95% confidence that they're going to pull back on their bond buying program. They're going to bring it from $65 billion down to $55 billion. Fed officials have signaled that very clearly. It's not even in the first paragraph of the story. We started preparing before we even wrote. We even see what the statement is. We know they're having a debate about what to do about their forward guidance about interest rates. The debate started before the meeting. There are a number of people, including Bill Dudley, who want to drop the reference to the unemployment rate, the 6.5% unemployment rate. What we don't know and what we need to wait and see, what we're waiting for, is what do they put in place of it. The Fed wants to continue to give the markets confidence that it's not going to be raising rates anytime soon. It doesn't look like they're on tap for 2014, but they got to figure out how to do that without anchoring themselves to the unemployment rate, and that's really what we're waiting to find out. It's all in the fifth paragraph of the statement. When you get the statement, go straight to the fifth paragraph. That's where the new language is going to be.
John, the 6.5% will likely be gone. The New York Fed president, Bill Dudley, pretty much signaled that when you interviewed him earlier this month, and they're going to replace it with some other language. What are we expecting from this language, qualitative language rather than quantitative?
I think we're going to see a few things. I think we're going to see, for one thing, Janet Yellen has placed a lot of emphasis on the Fed's dual mandate. Its mandate for maximum sustainable employment and for stable prices. And I think that we're going to see some indication from the Fed that rates are going to stay low. Policy is going to stay accommodative, as long as the Fed needs them policy to be accommodative to reach its dual mandate objectives. I think we'll still see some time references. The Fed has been saying that it expects to keep the short-term interest rates near zero for a considerable period after the bond buying program ends. So that's some calendar-based guidance, and I think we're going to continue to see that. And I think we could see some new references in the statement to what kind of path the Fed expects to see once it starts raising interest rates. The message there is that it's going to do so very slowly. It's going to raise rates very slowly when the time comes.
And for anyone who's following here, a few pointers. If you haven't been with us before, hit the blue button just below us to ask a question. You can insert your question into that box that comes up. It'll come up on the screen cue. And just if you're following along, make sure you're using that button up above us that says follow. Hit the follow button, and you'll get notices when we are doing spreecasts from the journal, so you can follow along whenever we're doing these.
Sudeep, we have a comment from Jeff Goldstein here about inflation, noting the CRB index is up huge. I just want to make a couple points of that. I want to kind of talk directly to our readers. One point is that so commodity prices have picked up early this year, but they're down from their peaks of a couple of years ago. If you look at the CRB index, by more than 20%. We've seen a bounce, but it doesn't make up for the amount that it's declined over the last couple of years. The other point I'd make is that consumer prices, which is what the Fed watches, are below the Fed's 2% objective. We just had CPI numbers out yesterday, and they were close to the PCE numbers. They were in the 1% range, which is well below the Fed's 2% objective, and that's what the Fed is going to be paying attention to.
John, there's going to be a lot of discussion about when the Fed will do its first rate increase. it could conceivably be raising rates a year from now. We want to discuss all of that when the Fed first rate increase comes, what is ahead, and we're going to be discussing it right after the break, the timing of the Fed's first rate increase. Stay with us. And we are back. John, the taper seems to be on autopilot. We know the Fed's going to be pulling back $10 billion each meeting from its bond buying program. The big question now is, when does it use its other lever and start raising rates? So what do you think? When will the Fed start raising rates?
Well, let's get back to what we know. We know that futures markets are, if you look at Fed funds futures, they're pegging the first rate increases in the second half of 2015, around September. We know that a number of Fed officials have told us that they're comfortable with market expectations. So what I think we can say today, and what I think will come out of the forecast that the Fed puts out, is an expectation that rate hikes start sometime in 2015, late enough in the year that they're not going to rise very much, probably won't rise above 1%. So, you know, the consensus right now is, I would say, around September of 2015. But then the important thing that you have to do is say, all right, what are the risks around that forecast? What are the circumstances under which the Fed starts hiking sooner? And what are the circumstances under which the Fed would wait longer before it started to raise rates? I think on the sooner question, it comes down to the behavior of inflation, which we just talked about in reference to Jeff Goldstein's comment. You know, the Fed is expecting a gradual return of inflation to the 2% objective. If it moves back this year quickly, then I think the pressure is going to be on them to start start raising rates, you know, earlier in 2015. I mean, there would have to be a real shock, I think, to get them to move this year.
And John, every time we've seen expectations that inflation would start picking up and the Fed would pull back on whatever version of QE it was doing, guess what? Inflation started pulling back a bit, and it was slower than they wanted, and the economy was falling apart. What would it take for the Fed to change course on tapering right now?
On tapering, the hurdle is very high. You know, so what they've been saying since they started this in September 2012 was they started the bond buying, was that they wanted to see substantial improvement in the job market, and they feel like they have seen substantial improvement in the job market, more than a percentage point decline in the unemployment rate, you know, steady payroll growth. And as long as they're seeing this improvement, they're going to continue to pull back on the bond buying program. You know, I think we would have to see a shock to the economy to get them to continue this program going. We would have to see really what we would have to see is substantial downward revisions to their growth estimates, or substantial upward revisions to their unemployment estimates, or substantial upward revisions to their inflation estimates.
And we do get those forecasts today, just as we get the statement at 2 p.m. We will get they're called the Summary of Economic Projections. We talk a lot about following the bouncing dots. When you look at the images, they'll have dots showing us where Fed officials are on the spectrum. John, there are fewer officials sitting in this meeting than usual. There are certainly fewer voters. There are going to be 9 voters at this meeting. Does that change the dynamic at all, because they're waiting on some confirmations in the Senate for the Board of Governors? Does this give any additional voice to some of the other folks who might be coming up, particularly from the regional banks?
If this were going to last for a while, I think that it could change the dynamic, because the board of the Fed is always very loyal to the chairman, and right now Janet Yellen is down 3 board members. But we're going to get two more as soon as the Senate confirms Lael Brainerd and Stan Fisher. She'll still be down one. So that actually puts a little bit more power in the hands of the regional Fed banks. But, you know, by my count, she shouldn't have more than 2 dissents today at the most. She might come away with none. But, you know, we tend to see hawks dissenting. I think she's going to have, she'll have her way in the voting. It becomes a problem, really, if the Senate dithers on confirming Obama's nominees for the board.
If you're following along, you can look in this box, the chat box. You can actually join the conversation. We've seen a couple of people in there already. I'm putting some of our
I'm
links in
waiting for
there.
Steve
And our
Goldstein's
producers are as well.
reply. You know, so we talked to Steve about the inflation
Jeff
numbers. I want to
Goldstein,
hear what he
he'll be
has to
back.
say.
He'll be back in here. I just put a link in there on something we've got on real-time economics this morning. We've got Fed coverage throughout the day there. This is a little item from George Akerlof, the Nobel Prize winner, what he said years ago in advice to a future Fed chairwoman. And the lead of that item is "Don't be too nice to the hawks." So we'll find out perhaps in the press conference whether she had been too nice to the hawks in that discussion.
Hey,
John,
hey,
I'm going to
Sudeep,
put up. We're going to come back to Jeff.
we asked Jeff to reply, and we got it. You know, he's saying breakfast is getting more expensive. Coffee prices up, lean hog prices up, cheddar cheese prices at an all-time high. Yeah, it's a fair point. If it's sustained, then we might have a problem. Frankly, I'm surprised by what commodity prices have done. I think given the slowdown we've seen in emerging markets, I wouldn't be surprised if commodity prices started softening again, particularly with what's going on in China.
I wouldn't be surprised if Jeff Goldstein needs to change up his breakfast a little bit because that seems like a pretty heavy one every morning. So, John, I'm putting up a question here from one of our viewers, Nasheen. How is this going to affect Europe? There's a lot of chatter, and I'm sure when we get the transcripts in 5 or 6 years on this Fed meeting, we will be able to see some pretty serious discussion about the events overseas, what's happening in Ukraine, the potential for additional volatility in markets. We've already seen that recently. The Fed is obviously not going to react at this moment to what's happening in Eastern Europe, but they have to be watching that. How are those events going to spill over potentially to the European markets and what the ECB does? And does the Fed have to respond or think at all about how the ECB reacts to those kinds of cases in its own decision making?
Well, frankly, I think the Fed is taking a little pressure off the ECB right now by pulling back on its bond buying program. It's taking a little pressure off of the ECB to move aggressively on its own front to address, you know, really low consumer prices there. You know, maybe if the Fed strongly reinforces its low interest rate message today, then the ECB actually has not gone very far in its own forward guidance. Maybe Mario Draghi takes a page out of the Fed in the ECB's playbook and starts giving his own assurances of low interest rates. But right now, in terms of use of balance sheet, because the Fed is moving away from using its balance sheet, it takes a little pressure, I think, off the ECB. Frankly, I think from the Fed's perspective, what's more important is what's going on in Europe and how it might affect the U.S. The Fed talks a lot about headwinds to economic growth here in the U.S. A lot of the headwinds that have upset Fed officials in the last couple of years have been headwinds from abroad, Europe's banking and fiscal problems, and now we see these events in the Ukraine. I'm sorry, in Ukraine, not the Ukraine. And there's some worry, I think, that we could have a new round of global instability. I don't think it's going to change the Fed's forecast right now, but it's a source of uncertainty that they're going to be watching. And I think it's a source of uncertainty that will make them reluctant to do anything abruptly or aggressively in this environment.
The Fed, of course, has faced a number of overseas events in recent years. Just look back 6 months, they were talking about potential for action in Syria just ahead of their September FOMC meeting when we were talking about the potential for a taper long ago. And pick any 3 or 4 month period, and there are always events abroad that they have to worry about and think about. John, the headwinds argument, though, from a domestic perspective, comes up a lot in these discussions. In the latest case, the headwind may partly be a very cold one with the cold weather and what that's done to the economy and to economic data. We discussed in the last Spreecast how this seems to happen every few months where the Fed can't get a clear reading on the economy and they just have to suck it up and deal with it. Is that what they're going to do now and just hope that their outlook remains solid like it was before and that things will be picking up by the spring and summer?
Sudeep, I'd love to see you at an FOMC meeting telling these guys to just suck it up and deal with it. But I think, yeah, that's pretty much the case. They there's more uncertainty about the data now than there typically is because of these cold weather effects. The important point here, I think, is it not only does it make them uncertain about the January, February, March data, but it's going to make them uncertain if the April data and May data even come in strong. Then they're going to, have to ask themselves a question about whether this is just a bounce back from unseasonably cold weather in the winter. So, we could be into June before they have a firm handle on how the economy is getting started this year. And then, by then we'll be looking at benchmark revisions into the middle of the year. I think, the one factor that could change the equation is if the data stays soft going into April and May, then the Fed starts getting a little uncomfortable and says, all right, this wasn't just weather, there's something else going on that's going to make us miss our forecasts. And, that's been the pattern really the last 3 or 4 years. It has not been until the middle of the year when the Fed has recognized that it was missing its forecast and it launched some new program late in the year. I find it very interesting. QE3, the third bond buying program, launched in September of 2012. Date-based interest rate guidance launched in December of 2012. QE2, the second bond buying program, launched in November of 2010. Very often when they do these things, it happens in the second half of the year after they realize they messed up their forecasts. So watch the forecasts and wait a couple of months is what I'd say.
John, we've got a question here from Nikolai that I'm putting up. It's a long one, but the gist of it, when you get to the bottom of it, is a great question. What are the options for the Fed to target specific risk in bubbly areas versus the blunt tool that the Fed has? We hear this a lot from Fed officials. You've heard it for decades. Interest rates are a blunt tool. They have macroeconomic effects. They can't target specific areas. QE, it's still pretty blunt, even though it can address some certain specific areas like housing and mortgage rates. What do they do when these things get out of control, other than discuss it and put it in the minutes so that we notice that they are worried about it getting out of control?
So, so this is a really interesting question, especially because Nikolai focuses on small cap stocks. So, just to take a step back, so in the Fed's mind, it's got two instruments for dealing with financial excesses. One instrument is what they call macroprudential tools. Their ability as regulators and supervisors to tell banks to knock it off and to find ways, for instance, by increasing loan-to-value ratios on mortgages, which is something that other central banks have tried. So kind of pinpoint tools to focus on the specific areas of excess without raising interest rates. The other tool is interest rates themselves. If they raise interest rates, they could tighten financial conditions. The Fed has said for a long time that it sees its first line of defense as the macroprudential tools. These are the instruments that they want to use if they see excesses. But here's the problem with that. One is that, and this is why Nikolai's point is very interesting. What happens if the excesses are in small cap stocks? That's not something that the Fed regulates directly. They regulate banks. They have some oversight of short-term funding markets. But if they see another tech bubble, for instance, they can't hit that directly with their own tools. This is something that Jeremy Stein has talked about, that the benefit of using interest rates to attack a bubble is that it gets in all of the cracks of the financial system. It gets to the places that the Fed doesn't regulate directly, And it also gets to the places that the Fed doesn't even see. They didn't know the problems that CDOs were causing a few years ago. So it's an alive debate, and right now the consensus inside the Fed is use macroprudential tools, but they aren't taking the possibility of preemptive interest rate moves if they really see financial markets get out of control. Final point, they don't see that right now. They don't see problems when they look at small cap stocks, biotech stocks, farmland prices. They think all in all that financial markets are on a pretty even keel.
John, is that really the case? How much do we really know that they believe some of this stuff? If you look at 96 and Alan Greenspan's warnings, he was actually as vocal as you could be when he starts talking about irrational exuberance in the late 90s. It was 4 years of using the bully pulpit to scream about these issues, and it turned out to be a fairly mild recession in the end. If you look at 2006 and 2007, Ben Bernanke was saying the subprime problem is contained. We will probably find out in his book a year or two from now that he wasn't all that confident that the subprime problem was entirely contained, and he had to say what he had to say because he was the Fed chairman at the time, and he would trigger something else. The Fed is not all that effective when it uses the bully pulpit. They have indicated, as you've noted, some of these issues in the minutes, and they've signaled some of their concerns about it. But how do we know when the Fed is trying to be cautious about disrupting markets, and how do we know when they are truly just not concerned about a certain area? And is it possible that they're just wrong?
Well, if you look at the minutes and if you look at their public comments, what you see is officials pointing to a few areas. Leveraged loans is another good example. A few areas where they see, pockets of maybe some excess, but not a lot. So, I don't think they're trying to hide anything there. I think that's the way they see the world. I think the bigger problem, which you point to, if you look back into the 90s and you're talking about the bully pulpit, yes, Alan Greenspan talked about irrational exuberance, but a central banker has to put his money where his mouth is at some point, and the Fed kept rates very low. Not only did the Fed keep rates very low, but because of Y2K worries in 1999, they were flooding the financial system with money as this tech bubble got more and more inflated. So it's really a question of what are you going to do about it when you see these excesses? And I think the lesson that the Fed learned in the late 90s and then later on during the housing bubble was that they can't ignore this stuff. They can't allow it to get out of control and then just figure they're going to clean it up when it's done, because we've had 2 disasters when they allowed that to happen. So they have to be more preemptive. The challenge is finding the right tool and having the right judgment to know when you've got a real problem on your hands.
John, I am putting up a link here so people can click on it very easily, wsj.com/Fed. It's a link to our new Yellen ebook. You wrote the intro to this ebook. It's already been downloaded quite a bit off our site. It's a great read on not only what the Fed and Janet Yellen are facing right now, but looking back over the past couple of years and even decades. Tell us what's in it, what you can get a sense of if you download this ebook.
So, I mean, the organizing principle of this book is, the Fed has a new leader. Her name is Janet Yellen. Who is this person? Where did she come from? And how does she think about the economy and the central bank? So what we did was we took a compilation of some of our best stories going back to the late 80s when we started noticing her on the landscape of economists, and we put together a lot of our best stuff about Janet Yellen and about the Fed and about the economy, and we created what you could describe as a briefing book on who is Janet Yellen and what is she going to do. We included some fresh new insights in an introduction that I wrote, and I think it's a great time to pick it up and take a look, because today's the day when it all happens. I actually got a note from a reader this morning saying that he downloaded this and read it on his iPad on a flight recently, and really liked the ebook format. So we've gotten, the last time as of yesterday, we had about 6,000 people who had downloaded it. Hopefully that number is growing. But if you want to be in the know, if you want to know everything there is to know about Yellen at this point, click on that link right there, and hopefully you can be one of the people in the know.
And I'm doing one other link here so people can see it. It's to our Grand Central email newsletter. If you click here, you can actually sign up for Grand Central, get it every morning in your inbox. It takes us on a tour of central banking issues and economic issues in the U.S. and around the world. It's definitely one of those things you want to catch up on. John, tell us about your take this morning. What's your take that's at the top of Grand Central?
Well, so the Grand Central, what I'm looking at today is negative real interest rates, and I think this is a really big issue that the Fed has to be thinking about. So, yeah, the Fed has, if you look at inflation-adjusted interest rates, the inflation-adjusted policy rate, it's been negative for a few years now. I think my number was 59 months. So what this means is the Fed is giving households and businesses and investors very large incentives to borrow money today and put it to work in the markets or the economy, because you're basically, you could borrow money for next to nothing and go out and buy goods and services or investments, and prices are going up more than the cost of borrowing. The question is, how long can they sustain that? We had negative real interest rates in the 1970s. We got a burst of inflation. We had negative real interest rates in the 2000s, from 2002 to 2005. We got a housing bubble. Can the negative real interest rates today be the source of the next period of excess that the Fed is fighting against? One thing you'll learn, I think, if you read today's newsletter, is that it doesn't always lead to excess. We had negative real interest rates in the 1940s for most of that decade. And the economy emerged in pretty strong shape in the 1950s. And it boils down to this bet. The Fed is betting that the economic backdrop and the financial backdrop that it's dealing with is more today like the 1940s and the Great Depression era than it is like the 1970s or the 2000s. That's Janet Yellen's big gamble, and it's a gamble she is going to reinforce today when the Fed puts out forecasts promising low rates for another couple of years.
John, we're going to take just one or two more questions that we've got here, including one here from Dina. The Fed has been lowering the level of long-run funds. Is that indicative of lower potential growth? And what does that mean for slack and inflation possibility? You're going to have to unpack that question. It's actually a very good one. So help us out and explain it a bit.
It's a very good question, and this is something that Bill Dudley talked about in an interview that we did with him 2 weeks ago. So, so one idea is that interest rates are so low right now, the cost of money is so cheap because the economy's potential to grow has weakened. It can't bear higher interest rates. And this is something that that Bill Dudley talked about. It's something that Mark Carney at the Bank of England has talked about. So when you boil down what the Fed is really effectively saying today, even though they're pulling back on this bond buying program, what they're saying when they promise to keep rates low is that the economy is not back to normal. It's not close to being back to normal, even though the unemployment rate is falling, even though they're doing less bond buying. They think that we still have a fundamentally weakened economy coming out of the financial crisis, and that the economy can't bear interest rates any higher than they've set them or that they're prepared to set them. So in the Fed's view, this weakened state means that the possibility for inflation is pretty low. But here's the problem: if the Fed overstimulates, if it gets rid of this slack too quickly, then if they misread the interest rate level that the economy can bear, then they actually could be setting the stage for a problem.
And John, how do they, when we get the minutes of this meeting in 3 weeks, what do you think we're going to learn about that discussion and about how the Fed is framing forward guidance. Are they going to want to tell us a lot about that? Are they going to want to just move away from their 6.5% threshold and maybe dance around it for a little while until they figure out what to do? How much are they really going to be able to decide in this meeting how they want to communicate this issue?
You know, I think Sudeep, what we're going to learn today and what we're going to learn in the minutes in 3 weeks is how successful is Janet Yellen as the Fed's new leader at building a consensus. If the Fed can't get, if the statement doesn't change a lot and they keep the 6.5% threshold, we know that there was tension, then we will know that there was tension in the room and that she had a hard time getting everybody to one place, because we know Charlie Evans, Dennis Lockhart, Bill Dudley, and a lot of people have said to us and others that they think that they've got to start moving past the framework that they've had since December 2012 of tying their the rate outlook to the unemployment rate. If they can't get past that, then Janet Yellen had a problem. And I think that the minutes are going to give us more insight into how did she go about building a consensus in this statement. How much disagreement did she have, which won't show up in the statement, but it will show up in the minutes potentially. You know, and I think it's worth remembering also, looking at the Bank of England, what happened when they changed their guidance last August. You know, a lot of people think they came out with a very fudged statement with a lot of caveats. And what we've discovered in reporting out a story about Mark Carney a week ago was that he had to work really hard to get his own very divided committee in the same place. And you ended up, as a result, with a lot of fudge factors in the statement. I think if there's pieces of this statement that are confusing, don't add up, that look like fudge factors, that's a sign that Yellen has a consensus problem on her hands.
We will find out all of that and more in just a couple of hours. As soon as we get off, John, we are starting our Fed live blog just around noon, wsj.com/economics. We will have all of the details from the Fed projections, the statement, the press conference, all the analysis that we've got right now on real-time economics is flowing through there. So check it out, and we will be back here again soon for another Spreecast to discuss the Fed and Janet Yellen. Thanks, John. Glad you didn't spill any coffee today.
Read our book. Read our book.